Hello and welcome back. So this is part 3 of my investing process where I'm going to talk about my buying and selling rules, how I decide when to buy and when to sell a stock. If you haven't already watched it, the previous part was my investing checklist, which is how I research specific stocks and things and how I decide which stocks make it onto my watch list to be considered worth buying. So I'd strongly suggest you go and watch that before watching this because everything will make a lot more sense. And part 1, previous to that, was how I come up with my initial ideas to get a list of stocks that I want to research in more depth. So yeah, if you haven't already, I'd strongly recommend just starting from the beginning, from part 1, and then catching up and watching from here onwards. So anyway, yeah, as I say, this part 3 is on buying and selling rules. So let's crack on with that. So I will only buy stocks that have passed my checklist, which are on my watch list. It keeps things far simpler. It means if there's any kind of exciting stories going on with a stock that's going up 50% every kind of few weeks, that I'm not tempted to jump on if it hasn't passed my watch list, passed my checklist to get onto my watch list. So I can only buy stocks that I've heavily researched, that I know how the company works, and I have just a strong fundamental understanding of that company, of that stock. It just makes things far simpler. So as I say, see the last video if you have no idea what I'm on about, where I run through how my checklist works and all of the points on that. So it has to be on my watch list before I buy. So what price to buy at? I've got these stocks on my watch list. How do I know when to buy them? Do I just wait for a dip in the price? Do I wait for some momentum? What do I do? Well, I use a value calculator as my first step. So there's lots of different ways of doing this. It's basically just finding the intrinsic value of a company. And there are loads of ways of doing this. Different people suggest that different ways are better than others. I found I didn't create this value calculator at all. I watched another video of someone making it, which was quite a while ago now. If I remember, I will link it, but I don't think I'm going to be able to remember where the video was, unfortunately. But effectively, I'll bring it up in a second, but this is just inputting figures into a spreadsheet that I've made, which will give you an eventual buy price. So you input the current earnings per share, either the current or the trailing 12 months earning per share. You input, let me pull up the spreadsheet because it'll be easier to see. So you input the current earning per share. So because I've been using this company as the example the whole way through all my videos, I'm still using Games Workshop. So their last earnings per share was 428 pence per share. And then you input what you think their growth is going to be going forward on average over the next kind of 5 to 10 years. So this is very subjective, obviously. I prefer to take a more conservative estimate. So if there is analyst coverage and they're saying kind of 16%, say, I'll never go above analyst estimates. I'll often go a bit more cautious. So I put 14% in here. That makes sense to me for a company that's still got lots of growth avenues. It's shown consistent growth over the past kind of 5 to 10 years. So there's not any reason at the moment to suggest that won't continue. I put in the minimum rate of return that I want, so that's an annual return. I mean, obviously, ideally, I'd like more than 12.5%, but 12.5% is my base that I want to achieve. So I want to ensure that I'm going to be getting that kind of return. And you'll see down here, I put if it's a really risky stock, I wouldn't class Games Workshop as a really risky stock at all. But if it is like a micro cap, like under 100 million, under 50 million kind of market cap, I'd class that as much riskier. There's a lot more things that can go wrong. They're still in the kind of early growth stages where a lot of problems can occur. Then I want a larger return for my risk, so I'll knock that up to 15% in that box. I'll always put a margin of safety in. So this is, once we calculate the value, so let's just keeping numbers simple, let's say that the value of the stock is 100 pounds or dollars per share. That's like the intrinsic value of the stock. I don't want to be buying at that because I want to give myself a bit of buffer in case some of the assumptions I've made are out, or the company comes across kind of unforeseen problems and things that are going to affect the share price. So I will, if the intrinsic is 100, I set mine to 75%, so that means 75% of that. So my buy price would be $75, just to give me that buffer room. And the idea is behind this is just to limit mistakes. Is to make, when we enter a stock, to be as sure as possible. Obviously, you're never going to be sure, and there's still going to be ones that go wrong. But as sure as possible that in the long run, we're going to be making money on our investment on that purchase. And we also add in the PE ratio, the average PE ratio for that stock for the last 5 years. Now, there's a bit of a caveat on this. If it's a crazy growth stock that's had a PE of like 50, 60, 70, you get this a lot with kind of some of the crazy tech US stocks, then I won't put in 60 or 70, or the highest I will ever go is around 40, and that's got to be for extreme growth and extreme growth potential. I will normally go around 20, and obviously that can go down as far as 10 for a slow grower, or I'll push it up, but I will look at the average their PE has been and then normally knocks them off that, especially if it's a company that's been growing rapidly and doesn't have such high growth potential in the future. If the growth potential is easing off, then the PE ratio should ease off as well in the future to match the future growth. So what this does is, it all sounds very common, but basically all I have to do each time is input these numbers into here, my assumptions, and it will spit out a buy price. So I will go through in the future, I may as well make a separate video of how you can set this up. It's not very difficult at all, you just need to put in some equations and it will spit it out for you. But I use this, quick assumptions. I mean, the research behind them takes a long time, but once you've got the research, you just input the numbers and it'll spit out a buy price. So for this, it gives us a buy price for Games Workshop of £72.30. So the reason for doing this is it gives a fair value for you to buy the stock based on the assumptions you've made. It removes that uncertainty. So for me, before I had this, I was always like, oh, is it fair value? Should I be buying now? Now that I've got this in place, once it goes below that price, I know that I'm getting a good deal on the stock. I do have some other rules now, and I've been learning over time. There's the old saying of don't try and catch a falling knife. So if a stock's in a very steep decline and it breaks through my buy price, I still won't buy it now until it kind of shows signs of a reversal. I say now because I have been doing that in the past, and I have learned through mistakes that if it's in a steep decline, it's likely to carry on doing that. So even though it's at the price that I think it's fair value for the stock, I'll still wait for it to show signs of recovery. And all of this just reduces risk, which is obviously what we want. So this is what it would look like on the charts. I've made this a luminous green just so you can see it far more easily. I don't normally have it luminous green. So this line here, so I've rounded it to 7,250. So that's in pence because it's a UK stock. But it would do exactly the same thing if it was in dollars. You input the numbers as dollars instead of pence. So this is my buy line. So I did these calculations originally back up here. So it was quite a long way below the buy price. So what do? Well, you just wait. And it may be that the stock doesn't get down to that price for years. It's fine, you wait. Obviously, when the company brings out new financial results, if their profits are improving, if their growth is improving, then you redo the calculation each time, and this buy price will move around. But it was up here, and yeah, I just had to wait. I saw it coming down and coming down and coming down. And I entered here. This is where I first bought the stock. It's quite a long way below my entry price. But what you'll notice here is what I wouldn't do now. Well, I still do make mistakes, so maybe I would. But what I shouldn't do now is enter here, because it's still in a very steep decline. It hadn't broken this downward trend. It hadn't put in any higher highs or lower lows or anything like that. It was still very clearly in a downward trend. Now I got lucky here in the fact that that was actually pretty much the bottom. It went a bit lower here, but it was pretty much the bottom. But I bought there, and then it carries on up. So the main thing is buying below this line. I think if you make all these calculations and you work out an intrinsic value and you're buying below it, I don't think you can go too far wrong. unless something fundamentally changes with the company, like they've completely cocked up their results and they go from a profitable company into a loss-making company and there's no sign of recovery in the future, then obviously in that situation it's not going to be great. But I think in most circumstances you're going to recover. And then so I buy here, and then the next thing I'd say is initial entry below that fair value line. If in a downtrend, like I just said, wait for a reversal is what I do now. And it doesn't have to be a full reversal, it could just be that it comes down. So for example here, when it bottomed here and started going up again, I would then consider that to be kind of in a sideways movement, a sideways trend. It's not kind of completely falling down. It's broken this downward trend line. Then now I would probably buy in here rather than here, just because we've got a little bit more confirmation that we're at or near the bottom. And obviously it could still go further down, but it's just to try and limit risk as much as possible. And in terms of my opening position sizes, so this goes back to the checklist score. So again, if you haven't watched that video, I'd recommend you go and watch it now. So to pass the checklist, it has to have 75 points or more. And then I'd break it down past that into different categories. So let's just use portfolio size of £100,000 or dollars. That's not the size of my portfolio, I'm just using it as an example. So if it's 75 plus, well, let's go from the other end. If it's 85 plus, so a really, really high score, then we'll have a total position size of 4% of the portfolio. So £4,000 or dollars would be our total position size. 80 plus, so 80 to 85 would be 3%, 3,000. And 75 plus, so 70 to 80 would be 2%, 2,000. So that would be my desired total purchase, like for the position. But my initial entry won't be that all in one go. It'll be 1/3 of that position. So again, to keep the numbers simple, let's go for the 8. Let's say the score's 82. So it'd be with £100,000 or dollar portfolio size, 3% of that would be 3,000. My initial entry would be 1/3, so it would be $1,000 or £1,000, depending on what currency you're working in, and that would be my initial entry. Then, if the stock carries on falling, then I would add to that position. I would ideally again wait for a reversal, but I would add to the position upon a reversal. If I was wrong, if I entered here and I was wrong and it carried on falling, I'd be like, okay, I don't sell immediately, I just hold, because we've done all our research, we know the company is a good company, we know that we've bought it below intrinsic value and that it should in future go up. So we're not going to panic, but we're going to, if it does carry on falling further, we'll wait for a definite reversal, and then once that reversal is confirmed, I'll add my second batch, and then when it starts climbing on pullbacks, I'll add again until we've got our total position. So I'd normally do 3 buys. I don't want to do too many buys because you could break that 3,000 up into kind of 5 or 6 buys, but when we're working with lower position sizes like that, your trading fees start to add up. So I don't think it's worth doing too many transactions. If you're dealing with a portfolio of 1 million and your position size is 30,000 rather than 3,000, then maybe you can start to do more buys and kind of spread that out over 5, 6, 7 purchases, just to spread that risk out even more. But as I say, I'll split it up into separate buys. Once it's going up, which is ideally what we want, then I would do purchase on pullbacks. Now, the thing I didn't do in this situation is because it had such a sharp rise from here up to here. I mean, really looking back in hindsight, I should have bought here, but it hardly pulled back at all, and I made the mistake of thinking it was going to have a bigger pullback, and it just carried on going up, and now it's so far above my value that I'm just holding with my initial entry for now. But in an ideal world, it would have pulled back down to here, I'd make a purchase, and basically the idea is to just add to your position until you've got a full size position, and ideally you'd have all of your buys below the intrinsic value line. Obviously, if it gets too high above the intrinsic value line once you've got your initial purchase, you don't want to be adding, because it's not good value anymore. Right, so now we have our entry positions. We own the stock, we've bought in, we're now very excited for all the profits we're about to make. So let's say you've got a full position now, or let's say I've got a full position now. When do I sell? So I have some kind of core selling rules to make it a bit easier for me to decide when to sell. So if the checklist, so I'm obviously updating my checklist score all the time. Whenever they release new results, whenever they release trading updates, I'm going and seeing if the checklist score needs to be updated. So if the score for the stock falls below 75, so if it falls to 74, sell. I'm out of the stock. Now sometimes that's not going to be the correct choice in hindsight, but I found I need some hard rules, because a lot of the times in the past I've had very soft rules, or I've had rules and I've broken them, and it's led to me making mistakes. And in the long run, yes, you might not be right on all of the sales you make, but it's going to avoid me having those big mistakes where I don't sell and it ends up dropping kind of 40, 50, 60%, and I could have got out a lot sooner. At the end of the day, if the checklist score is declining, the stock in general is declining. Something's not going as well as it used to be, so it's probably a kind of a sign to get out. If they release a major profit warning, so not just a minor one that they're going to be off for the next quarter or whatever, but if they release a major profit warning where normally my major profit warning is kind of their profits or revenue are going to be kind of 20% off what they thought they were going to be, then I will sell. As you can obviously have profit warnings that aren't going to take the checklist score below 75, but if it's a major one, I'm going to get out of there quite quickly. And again, that's just, if there's something major, it probably means there's something more fundamentally wrong with the company, and that often takes time to actually trickle through and really affect the share price. You'll probably get an initial drop, but from my limited experience in the last few years, I have noticed the old saying that profit warnings normally come in threes. It does tend to be kind of eerily true. Normally if there's a big profit warning, it won't be the last one. There'll normally be another one a few months later, the share price will fall again, and then again. And it can be difficult. This is something that I've struggled with. When there's a profit warning, you can never get in time. If there's a profit warning before the market opens, the share price could be down 20, 30, 40% even on the open, and you've not had a chance to sell. It's really frustrating. I find it really annoying, but there's nothing you can do about it. That's just the way it works. And I find it very difficult to sell a stock when it's just dropped 30% at the open. I'm like, well, if I just hold, maybe it will come back up a bit. But I'm trying to teach myself to not do that, because if it's a major profit warning, more than often it doesn't seem to in what I've seen, and a lot of books of things I've read back that argument up. So now if there's a major profit warning, I try and make myself sell. I'm going to do a video on my mistakes. I've made a lot of mistakes. As I say, this whole channel is just about my journey as a private investor. I'm very much a reasonable beginner. I've only been going 2 or 3 years. I'm learning. This is not financial advice. This is just kind of my experience, which I think might be quite entertaining for people or interesting. But I've made lots of mistakes. I am still holding stocks where I didn't sell on the initial profit warning, but now they're down kind of 70-80%, and I'm like, well, it's not worth selling now. But again, maybe it is. I don't know. Maybe that's another thing I'll learn in a few years. I should be selling them, but I'm now holding them, waiting for that recovery. But I don't want to be doing that in future, so I now have this rule that if there's a major profit warning, I sell. I'm out. And then also, this is more kind of portfolio management, which I'm going to do a video on next. That'll be part 4, the final part of this investment process. But if a stock gets to more than 15% of my total portfolio size, I will take profits. I haven't actually had a stock do that yet, so I'm not sure how much profit I will take. But if you think that the largest position size I can open with at the moment is 4%, that's got to have gone up almost 400%, 300% to get to that stage. So I imagine I'll probably cut it in half or something, but I would certainly take profits, and I won't have any stocks that are more than 15% of my portfolio. Just because if anything does go wrong with that stock then, and they have released a profit warning or something and it drops 30, 40%, it would be a big hit to my portfolio then, and B, I'd find it quite hard to take mentally. I think if I had a stock that was 20 or 30% of my portfolio and it dropped 30% in one morning, that'd be quite hard to take. And I know there's the rule that the more concentrated you are, the better your returns are, but I think it's something you have to you have to work out personally for you the amount of risk that you're willing to take. And I just know for myself that if one stock lost me 15% of my portfolio in one morning, I'd find that very difficult. So I'm not going to get myself in that position. And then there's also, so these are kind of the definite rules. There's also some that are kind of consider selling, have a think about it, and take it on a case-by-case basis. So if there is a long-term uptrend and it breaks in terms of what I'm talking about the stock chart. So you can see here I got this image from Investopedia. So this is the share price kind of going up over a long period of time with a trend line that's supporting it at the bottom here. If it breaks down through that, then no matter what the future prospects have been, no matter what checklist score it has, that's probably not going to be a great sign in terms of the short-term share price. So I'm going to think about either taking some profits. It might not be that I sell the entire position. It might be that I sell 50% or something. But in that situation, especially if it's as clear cut as it is in this example here, then I'm going to take something off the table. I might even sell the whole position. So that's kind of more of a trader mindset than a long-term investor. But if it's such a long uptrend as that, you're normally going to get quite a big sell-off. So I don't see the point in holding during that kind of event. If there's bad news for the company or the entire industry, so this could be lots of things. Quite often there's news about kind of CEOs leaving or acquisitions falling through, those kind of things, or just industry-wide kind of bad news, things that are going to affect an industry as a whole. So again, this is on a case-by-case basis, and it involves kind of staying up to date with that company, but also with the industry that they're in and the wider markets. So that's just a case-by-case basis, just checking nothing's going wrong. If there's a very large director sale, so I don't pay too much attention to smaller director sales because obviously the directors are going to want to take, they're going to want to sell some shares, especially from their incentives and things to live on, to diversify, to buy a house, all that kind of things, put their kids through college and university and things. But if there's a very large one, so one that's if they're selling 50% of their stake in one go, or kind of tens and tens of millions, which is kind of more than you'd use to buy a house or whatever like that, then I'll take a bit of notice, especially if it's multiple directors. So if the CEO, the CFO, the COO, the chairman, president, if they're all selling quite large amounts at the same time, then that's not personal reasons. There's something going on there, and I'll consider kind of trimming my position at the same time, because obviously they're going to know more than I do about what's going on. But I will reiterate that I won't pay too much attention to just normal sale sizes. If the CEO has been selling £1 million worth of shares every year for the last 10 years, that's fine. I won't pay. That's just his or her standard way of doing things. They're taking some money out of the table, they're diversifying it, they're using to live on or reward themselves, that's fine. It's just if it's an out of the ordinary large sale. And then what we've had quite a lot of in the past few years, a black swan event. So black swan events are events that are not usual, they're supposed to be quite rare and not come along very often, and these would include, so the COVID pandemic, and the Ukraine war. Probably not supposed to be saying these on YouTube, I'll probably get demonetized or whatever, but I'm not monetized anyway, so yeah, these two things. So as I say, they're not supposed to come along very often, but we've had 2 or 3 in the last kind of just 3 or 4 years. But I wasn't that invested in individual stocks when this came around, but if I had been, I probably would have considered selling. That's what I mean, like, and it's hard to judge, I think as well, but do you sell when this kind of thing hits? When the event in Ukraine hit, I did sell a couple of my stocks that I thought would probably get affected by what was happening in that part of the world, and it turned out to be a good decision because they fell. So those kind of things, and it's not a I will sell on any kind of black swan event, but it's something I'll look at all of my stocks, go through, see if any of them are going to be affected and by how much, and just take a judgment on whether I think it's worth selling them or trimming the position. So that's how I would get out of the stocks. So it's quite straightforward, basically. We're back to the beginning. I will only buy stocks from my watch list. I use my value calculator to find the price to buy them at, which I think is a fair price for the value of the company. I get my position sizes in, and then I sit on that stock until any of my selling rules is triggered. And I'm just constantly working through buying and selling, going along with the system and researching stocks to add to my watch list. And I find it very useful to have all of these rules in place, because it just means obviously I've got to instigate everything and do the research and look what's going on in the world, but whenever any of these events are triggered, the decision is made for me, and I either enact the buy or enact the sell, and it just makes things a bit simpler and a lot less stressful than it used to be for me when I didn't have these rules in place and I was buying and selling at the wrong times and making lots of mistakes. Anyway, my next video is going to be on portfolio management, so this will be part 4 of my investment process, and that will be it. That will be the whole investment process series wrapped up. So yeah, on portfolio management, how many stocks I hold, how I make sure that it's diversified across different sectors, and that type of thing. Yeah, just broad portfolio management. So I hope you enjoyed this video. If you have any questions or comments or advice or anything, please leave a comment below. Yeah, I hope you enjoyed the video, and if you have enjoyed the video, please consider subscribing, dropping a like. It does help a lot, and I'll be making lots of videos in the future. So yeah, I hope you have a great day, and I will see you soon.